The silent breakout. Why gold, silver, and miners are set for an explosive move based on analysis by Michael Oliver, EST Runtime. 12 to 15 minutes educational/credible tone, key numbers, at a glance $300 to $500 silver price target, $8,000 gold bull case, 8x historical bull, multiple 1.5% silver/gold ratio today B-roll. Aerial shot of a gold mine at sunrise. Cut to ticker screens showing gold price. Overlay. Gold, $3,200/Oz. April 2025. What if the biggest financial shift in a decade is already underway, and most investors have completely missed it? In this video, we're going to walk through the full technical and fundamental case for gold, silver, and mining stocks, drawing on 40 years of momentum analysis from market veteran Michael Oliver. We'll cover why silver is still historically cheap relative to gold, why gold miners are trading at a fraction of their long-run valuation, and what could trigger an explosive acceleration across this entire complex. Let's start with the timeline. B-roll, animated timeline graphic, March 2024, June 2025, November 2025. Show silver price at each date. The story starts in March and April of 2024. That's when Oliver's long-term momentum system issued its first major buy signal on gold, silver, and the miners. At the time, silver was trading near $26 an ounce. Gold and the mining indices were significantly lower than they are today. A second buy signal came in June 2025. And then, what Oliver calls the final major point of entry, came in November of last year, when silver broke out on the spread chart relative to the S&P 500 and also versus gold. At that point, silver was trading near $56. Average those three entry points together, and you get $36 an ounce. As we record this, silver is near $72. That's already a nearly 2x return from the average entry price. And Oliver's thesis says the real move hasn't started yet. Key point: Oliver is no longer issuing major primary entry signals. The thesis now is about staying in the trade, not getting in for the first time. B-roll, animated line chart, silver to gold ratio 1980 to present. Highlight 2011 peak, 3.2%, and today, 1.5%. Data labels at each key point. Let's talk about why silver, despite already doubling, is still considered cheap. The silver to gold ratio measures how much a single ounce of silver is worth as a percentage of an ounce of gold. Right now that number is about 1.5%. In 2011, at the peak of the last precious metals bull market, that ratio reached over 3%. Oliver's longer-term target is 3 to 6%, meaning silver still has to at least double relative to gold just to match its prior peak. Silver is also a monetary metal, used as currency for thousands of years. That fundamental characteristic doesn't disappear simply because the ratio has drifted low for a decade. The ratio chart broke out of a multi-year basing pattern in November, which is what triggered that final buy signal. The spread versus the S&P confirmed the same message: buy silver. Graphic CUE, on-screen text. If silver reaches 3% of gold at $5,000, gold equals $150/ounce. At 6% equals $300/ounce. Animate the math. B-roll, candlestick chart of gold or silver showing the January 30th spike down and recovery. Annotate, final low held 2 hours. Draw the higher low structure. Now, the recent volatility, because this is where a lot of people got shaken out. In late January and early February, gold and silver sold off sharply. Oliver had anticipated a midpoint correction. He just expected it in April, not the end of January. When it came early, it caught many people off guard. But here's the critical question a technical analyst asks: did the sell-off break any long-term momentum metrics? The answer, according to Oliver, is no. Last week, gold and silver probed below the January lows and stayed there for just 2 hours before reversing sharply higher. That kind of false breakdown, where price pokes into new lows and then immediately snaps back, is what technicians call a final cleansing poke. It's the market washing out the last weak hands before the next leg up begins. Compare that to the genuine top in 2011. Gold dropped from $1,900 to the $1,500s and never came close to recovering the old high. That was a real momentum break. This current correction hasn't done that. Key distinction: short-term momentum can break and heal quickly. Long-term momentum breaking is a fundamentally different signal, and that has not happened here. B-roll, daily gold continuation chart. Mark late January peak close, $5,300. Mark early March peak close, also near $5,300. Label both. Annotate, air is not as thin as expected. Let's look at where gold sits on the price chart and what the key levels are. 3 months of price action stalled around the $5,300 to $5,400 range, with one brief spike above $5,500. That kind of multi-month resistance might look like a ceiling, but pull up a daily continuation chart of gold and look at this detail. The peak daily close in late January was just above $5,300. Then, in early March, gold came back and matched that same closing level. In a market that had genuinely peaked, you typically don't return to the high. Gold in 2011 made its top near $1,920 and never came close to that price again. The fact that gold returned to $5,300 on a closing basis suggests that level is not thin air, it's a launch pad. Oliver's price-based trigger for the next acceleration. Gold reclaims $5,300 and silver crosses back above $90. When both happen, momentum traders get forced to cover shorts and fresh buyers pile in. B-roll, bar chart, XAU/gold ratio, 25% average 1980 to 2008, 2015 collapse to 4%, today's 7 to 8%. Clear labels. Then, a double in the ratio plus gold at $8,000 equals 3x in XAU price. Of all the assets in this complex, Oliver argues the miners may represent the most asymmetric opportunity. The XAU index, the Philadelphia Gold and Silver Miners Index, around since the 1980s, historically traded at about 25% of the price of gold. One share of XAU was worth roughly a quarter of an ounce of gold, on average, across several decades. In 2015, that ratio collapsed to just 4%. The mining stocks had become almost absurdly cheap relative to the metal they produce. Today, that ratio sits at roughly 7 to 8%. Better, but still far below the historical average. Even the low end of the multi-decade range was 17 to 18%. Getting back just to the floor of normal would more than double the miners in relative terms. Run that math with gold at $8,000, which JP Morgan has cited as an ultimate target, and a doubling in the XAU to gold ratio translates to roughly a tripling in the nominal price of mining stocks. Both the XAU to gold and the HUI to gold spread charts have recently broken out of their basing patterns. Technically, they're confirming the same signal as the silver to gold chart. The underperformers are about to lead. B-roll, split screen, S&P 500 chart on left showing topping pattern. Gold chart on right rising. Overlay 2000, 2007, 2025. Fade and slash out. Everything we've covered so far is technical analysis, momentum, ratios, chart patterns. But Oliver layers in a fundamental macro thesis that makes the technical picture even more compelling. The stock market, in his view, is in the process of topping out, just as it did in 2000 and 2007. And the early warning signal is coming from the financial sector, not from AI or technology. Historically, the leader of a prior bull market suffers the most on the way down. AI and technology have led the last leg of this bull. But watch the financials. Several key banks have already broken their quarterly momentum structures. Quietly, without headlines. That matters because nothing triggers a Federal Reserve panic more than visible stress in the banking system. When, not if, according to Oliver, a major bank shows public distress, the Fed's response will be aggressive, printing money at a scale we may not have seen before. Smart money is already moving, not into treasury bonds, into gold and silver. When public awareness catches up, when the stock market break becomes undeniable, Oliver expects a massive capital rotation into monetary metals. That is the fuel for the acceleration phase. B-roll, return to on-camera host. Gold bars or coins in soft focus background. Final graphic, price targets on screen. Let's bring this all together. According to Oliver's analysis, backed by 4 decades of momentum data, we are in the middle of a multi-quarter acceleration in gold, silver, and mining stocks, not the end of it. The primary buy signals were given in 2024 and 2025. The recent correction did not break any long-term metrics. The silver to gold and miner to gold spreads have both broken out of decade-long bases. And the macro backdrop, a topping stock market, stressed financials, and a Fed that will respond aggressively, sets up a powerful fundamental tailwind. Price targets: gold at $8,000 as a base case, matching the 8-fold multiple of the 2 prior bull markets. Silver at $300 to $500, achievable if the silver to gold ratio simply normalizes. And mining stocks with the potential to triple in nominal terms. The short-term triggers to watch: gold reclaiming $5,300 and silver crossing above $90. When those happen, Oliver believes the next acceleration phase begins. Call TO Action. If you found this breakdown useful, subscribe. We cover long-term market analysis like this regularly. Drop a comment. Are you holding gold, silver, or the miners? Disclaimer: this script is for educational and informational purposes only and does not constitute financial advice. All price targets and analysis are drawn from publicly available commentary by Michael Oliver. Past performance is not indicative of future results. Always conduct your own research before making investment decisions.